going to discuss some of the most impactful changes pertaining to 529 plans under the One Big Beautiful Bill Act of 2025, in addition to a few state-specific changes.
For sure, Ed. So the new tax law has definitely reshaped 529 plans, ultimately making them more flexible and useful for educational purposes for our clients.
So Ryan, for those that maybe are not familiar with 529 plans, can you give us a quick summary?
Sure. So 529 plans are tax advantage education savings accounts established under Section 529 of the Internal Revenue Code. They essentially help families save for qualified education expenses, which can include any of the following: college tuition, books, room and board expenses, even K through 12 tuition, which we'll talk about some of those more restrictive limits to K through 12 momentarily. In terms of funding 529 accounts, really anyone can fund them. Parents, grandparents, relatives, friends, or even non-family members can fund the accounts. And the contributions can be made to a 529 account you own directly. Someone else's 529 plan is a gift contribution. And the advisory note there is just to keep in mind that any contributions made to these accounts are considered completed gifts for purposes of gift tax. So ultimately the gift tax rules are going to apply here. So for 2025, that exclusion limit is going to be $19,000 per donor per beneficiary.
So now that we've introduced the plans, what are some of the changes under the new tax legislation?
For sure. So the main changes for the 529 plans are going to pertain to a few areas. First one being increased K through 12 withdrawal limits, expanded eligible uses for the funds, and also broader definition of what is considered a qualified expense. So prior to the tax law change, distributions were limited to $10,000 annually per beneficiary for K through 12 uses. So with the law, this limitation was doubled to $20,000 per beneficiary, and this is for tax years beginning after December 31st, 2025 is how it's written. What that really means for taxpayers is starting in 2026, they can use $20,000 per beneficiary for funding that K through 12 education. And note, there is no distribution limit to post-secondary programs as long as the funds are being used for qualified education expenses. So just note that, the limit is capped for K through 12, not higher than that essentially. So in terms of qualified expenses, these were expanded really to include curriculum materials, online educational materials, tutoring expenses, standardized test fees, dual enrollment fees, which we see commonly in K through 12 with the AP programs and dual credit programs, qualified post-secondary credentialing expenses, which is helpful for us to, get our CPA licenses, and educational therapies even for students with disabilities. So really just across the board, there were advancements in pretty much all areas.
Pretty substantial expansion there.
Yeah, for sure.
So Ryan, what would happen if a 529 plan still has funds in it and they're not used for education? I mean, what actually happens to that money?
That's a good question. So ultimately, there's a few options that our clients have. The first one being essentially what's called a change of beneficiary. So oftentimes we see clients, that have multiple dependents, to where, let's say, the oldest child decides not to go to college, or maybe their college is fully paid for. They can always have what's called a change of beneficiary to essentially allocate those funds to another 529 plan beneficiary, which is what we most commonly see. Another option available is under the Secure Act 2.0 of 2023. We can initiate a transfer to a Roth IRA now. So this essentially allows you to roll up to $35,000 for the lifetime of the beneficiary from a 529 plan account to a Roth IRA, but there are very strict rules here. So essentially the beneficiary has to have had the account open for at least 15 years is the first rule. Second rule is contributions and earnings rolled over have to have been in the account for at least 5 years. And then third, each year's rollover is limited to the annual Roth IRA contribution limit. So you always have to keep that into account as well. Some other more less commonly used but available options for our clients to move these funds is to roll over into an ABLE account, which is for individuals with disabilities. So this allows you to roll over the annual gift tax exclusion amount into an ABLE account, which, as we discussed previously, is $19,000 for tax year 2025, or also used for student loan repayment. So for our taxpayers that ultimately have student loan debt, they are allowed to use up to $10,000 lifetime per beneficiary to be used to pay down qualified student loan debt, which is an option sometimes we see. And then I would just like to add a disclosure that you can always technically withdraw from the 529 plan account, but if it's for a non-qualified use, the earnings portion of that distribution is going to be subject to income tax plus a 10% early withdrawal penalty. So keep that in mind when ultimately deciding to act here.
And I will also throw in that the IRS has not given us the final regulations as far as the 529 conversion, so stand by, more to come on that.
For sure.
And then lastly, let's kind of talk a little bit about the benefits that our Indiana and Illinois taxpayers are going to be able to take advantage of.
Absolutely. So the majority of our client base, are either Indiana or Illinois residents, just local to us as a firm. And so just to touch base on those benefits offered by the state. So first, Indiana is going to offer 20% state income tax credit on contributions made to a qualified Indiana 529 plan, which primarily is the college choice plan. And that is up to a $7,500 annual contribution, which would yield a corresponding $1,500 tax credit on the Indiana return. On the other side, Illinois does offer a benefit as well of a $10,000 deduction for single filers and a $20,000 deduction for married file joint taxpayers on their Illinois return. Similar to Indiana, those accounts have to be set up with a qualified state-sponsored 529 account, which in Illinois is going to be the Bright Start or Bright Directions programs.
Wonderful. Well, Ryan, I want to thank you for your insights, and that's going to wrap up this episode of the BOBCAST discussion on 529 plan changes under the One Big Beautiful Bill Act. That is quite a mouthful. Say that fast 5 times.
Yep.
As always, please contact a member of our team before you make any impactful decisions, as the tax law changes may affect you differently.
For sure. And to that, cheers, Ed.
Cheers.
Thank you for watching this episode of the BOBCAST. Until next time, so long.